And it's time for a pleasant Wolf Street article from Wolf Richter at, of course, wolfstreet.com. All of a sudden, mortgage demand cools, says Fannie Mae. Mortgage demand, huh? So what happens when prices are at all-time highs again and mortgage demand cools? Well, does that signify a turnaround? Again, most likely for numerous reasons, not just because, just because they're at all-time highs, but the same stuff that was happening in 2006, 7, leading into 2008, have absolutely been happening lately. The telltale signs are all here again. Therefore, we would all easily assume it's going to end the same way. There's going to be fire sales for houses in the near future, etc. And I know, I still see the comments. Joe, then why in the hell are you buying now? It's at the high. Because this particular house is not at the high. It's selling for quite a bit less than it was in the all-time high of 2006. And it has a brand new roof, brand new air conditioning, brand new pool system, saltwater pool with the little heater thing. Unbelievable tile. I was like, what is this? Is this what kind of counters are these? Like, countertops and stuff. He goes, it looks like it's marble. He goes, I don't think, he said that, I'm pretty sure that's actually marble. Hold on. I'm about to move into a house with marble countertops. Jason at 4. That just don't sound right. That's not our kind of lifestyle. That's not the kind of stuff we move into. But again, this person put in a ton of high-end, big money stuff into this house, thinking they could flip it for a lot of money, only to realize they couldn't. They had to keep coming down until someone bit. And that someone, when it got down to the right price, was me. Considering cryptocurrencies went crazy with Veritasium, I sold off most of them for a nice down payment. As you know the story, because I keep telling you almost every freaking day, I'm going to freaking write a book. I am going to write a book one of these days, probably in the near future, when I do the next flip of cryptos or the one after that or whatever, and I'm having some serious money in my possession, I'm going to have to write a book. How, from geek to chic, if you will. Although I'm not talking that kind of money. That's not going to happen with me. But I'm certain I can flip this next one, like the pay tokens, the one after that, whatever that one may be, etc. And I've been telling people which one's a good one. We've been saying this for a while. I think it was also in the Robot Report. It's called Kin, K-I-N. And it's that messaging app to compete with Facebook kind of a thing. It's not out yet. There's no ETA yet, so no one really knows. Just keep it on your radar. When Kin comes out, K-I-N, you're going to want to try to get on it, plain and simple. And yes, there may be one or two before that come out that may be better, may be good. Who knows? It appears that even the ones that, that wasn't any good. Oh, well, I flipped 7 times my money in that one. Oh, yeah, that was horrible. If you're not flipping, 33 times your money, you suck. 7 times your money. Imagine telling someone you suck because you only flipped it 7 times. And that's what we're hearing in these cryptos. So it's almost like none of these can lose, but some of them really, 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 really win. You know what I mean? Anyways. Mortgage demand cools, says Fannie Mae. Home prices are weighing on affordability and constraining sales. Here's another piece of an incomplete behind-the-scenes puzzle of the housing market that has surged to record highs. Fannie Mae, one of the government-sponsored enterprises, or GSEs, that guarantee eligible mortgages and package them into mortgage-backed securities that are then sold to institutional investors on Wall Street, had some disconcerting words in today's Mortgage Lender Sentiment Survey, which was actually the day before Monday, for quarter 2. More mortgage lenders say they have eased credit standards recently and expect further easing in the coming months. What does that mean? Easing, quantitative easing? No. We're not talking Bernanke, the Ben Bernanke. No, easing. We got to lower the standards. We got to lower the credit scores. We got to have to look past a couple of those credit issues. You're approved. That is what easing credit standards means. So why? Cooling demand for mortgages. Mortgage lenders in the survey include banks of all sizes, specialized non-bank mortgage lenders, such as the ones that don't take deposits, in credit unions. The net percentage of mortgage lenders that reported having eased credit standards over the past 3 months has been rising since Q4 2016. And the net percentage of lenders that expect to ease credit standards over the next 3 months for all three types of mortgages, GSE eligible, non-GSE eligible, and government loans such as FHA and VA insured mortgages, reached or surpassed survey highs this quarter. The chart below shows the net percentage of mortgage lenders who expect to loosen credit. Let's take a look in case you want to see. I'm that kind of guy. Chart below shows the net percentage of mortgage lenders who expect to loosen credit standards of GSE eligible mortgages. The conforming mortgages that adhere to GSE underwriting guidelines including loan limits. Expectations to ease credit standards climb to new heights. There it is. And that's not just a little bit of an increase, my friends. That's climbing a steep mountain up. In other words, we need to seriously ease our standards because, as I've always told you guys, even back from when the first crash happened, all these people with bad credit all over the place, I've said this numerous times, they're going to have to ease their guidelines because if they don't, they go out of business. They have to let people go. We're not making enough money on these loans and interest rates because our standards are too high and everybody has horrible credit. So we're going to go bankrupt or we're going to ease the standards. Naturally, they're going to ease the standards. So, new mortgages declining. Oh, no, whoa. No, ease, baby, ease. Take a page out of Bernanke's book. Let's ease. When there's something going wrong, you must ease it into shape. Shape it up. It's not too late to ease it. Ease it good. The driver behind the loosening of mortgage standards? Lenders want to write more mortgages. That's their business. But the business hasn't been going all that well recently. Just when home prices across the country, and in particular in certain cities, have surpassed prior bubble highs, and prudence would now be more important than ever. So what drives them to lower their standards? Cooling demand for mortgages. Lenders' increasing concerns over economic conditions drove the easing of lending standards as mortgage demand has taken a hit, and as the share of lenders who reported growth in purchase mortgage demand dropped to the lowest net reading in many years. The report across the three loan types, the share of lenders who reported growth in purchase mortgage demand dropped to the lowest net reading in years for a second quarter period. Purchase mortgage demand drops to the lowest reading in the past 2 years, year over year. And if you want to look at this chart, it shows you right there. It's all in black and white, etc., etc. Good day, sir. GSE eligible, non-GSE eligible, and government. All three types are saying, ow, baby. Very ow. Comments on why demand for mortgages was cooling differed by institution size. Large institutions said higher rates, uncertain economic times, and competition. Medium-sized institutions said lack of inventory. We are an affiliated mortgage company, and the lack of inventory in our markets affects our business directly. Whoever you mid-sized institution are, have you even spent a second of time on Zillow? Lack of inventory? Are you kidding me? There's houses for sale everywhere. There's foreclosures everywhere. All of the above, all types of sales everywhere. Pick up any major city, take a look, and you'll be shocked at how much is for sale. Anyways, smaller institutions say higher rates and cost of housing. Okay. The report pointed out that this drop in demand for purchase mortgages confirms Fannie Mae's report earlier in June that found that Americans were souring on the housing market, with the percentage of those thinking that now was a good time to buy a home dropping to a record low. Easing credit standards might also be due in part to increased pressure to compete for declining mortgage volume, said Doug Duncan, Senior VP and Chief Economist at Fannie Mae. In face of declining demand, competition among mortgage lenders to write mortgages heats up. So they get more aggressive with their rates, which lowers their profit margins. And 71% of lenders blame competition for their lower profit margin outlook. And the highest percentage in the history of the survey, and up from 44% a year ago, in case you're wondering. Fannie Mae's Duncan expectations to ease credit standards climbed to survey high points in the second quarter as more lenders reported slowing mortgage demand and increasing concerns about competition from other lenders. Well, if you're concerned, you just pull a JP Morgan and that bank gets collapsed. You pick up the pieces. Now you've got all their clients. You've got their mortgages, Put one of those numbers. But the mortgage lenders remain an optimistic bunch in terms of home prices. 78% said that home prices over the next 12 months would rise. Also a survey high, with only 3% daring to think that home prices might go down over the next 12 months. I think you and I both know they're going down in the next 12 months. Why did you get your house then? I already told you. It's a dream house. It is a dream house. Dream house. Come back to me. You remember Stevie B, anybody? Does anybody remember Stevie B? Except that wasn't Dream House. It was Dream Lover, Dream Girl, Dream Love. Come back to me. Anyways, the report summarizes tight inventory has pushed up home prices, which is weighing on affordability and constraining sales. The survey, just another piece of the puzzle of a housing market that has boomed in many cities beyond what is sustainable and affordable. Now the Fed has embarked on raising short-term yields and has brought them up 1 percentage point. Long-term yields continue to drop and mortgage rates remain historically low. But the Fed is now also targeting long-term yields with its strategy of unwinding QE, and as you know, they call it now QT, quantitative tightening. QE was designed, among other things, to bring down long-term yields and mortgage rates, and it did so successfully. Hence, the surge in home prices. Unwinding QE, or QT, including shedding the mortgage-backed securities now on the Fed's balance sheet, will eventually have the opposite effect. Just when home prices have surpassed the prior crazy bubble peak in some cities, just when home prices have surpassed the prior crazy bubble peak in some cities by a big margin, which is true. But where my particular house is, not quite as much true. But yes, if the house was still available in a year or two from now, I do think I'd be able to pick it up for a lot cheaper. Problem is, I wouldn't even bet, even kind of, that it will be available in the next year to 2 years, which is why I had to pounce. Pounce, pounce, let it all out. This is the dream home I've been talking about. Come on. I'm talking to you, shills and haters. Take care.